Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And boy, it is shaping up to be a really ugly day in markets right now.
We've had a couple of these Mondays where things start off really rocky.
Yeah, and usually it followed through on Fridays, but we saw some interest on Friday, so maybe this will turn around. But let's get to the biggest stories right now, the more than $15 trillion global ETF industry. And as we were just talking about, lots of pain, no gain. Stocks potentially headed towards their worst drop this year as fears of an economic slowdown and tariff anxiety really grip these markets.
And in just moments, we're going to speak with Holly Framsted of Capital Group on what the market turbulence means for product selection.
And amid the market turmoil, Bridgewater debuts its famous all-weather strategy in the ETF wrapper for the very first time. All that and more coming up, but as always, Eric Balchunas from Bloomberg Intelligence. He's here with us now. He's looking at the flows. Eric, what do you got?
Katie, Scarlett, you would think the flows would be a little more subdued given the market performance out there, which hasn't been great in the U.S., but it's really good. I got to be honest. VU, $4 billion, that's a ton. Now, you may say, well, Vanguard always takes some money. Well, fine, but, you know, this is a base of buyers who really never leave. In fact, I think a lot of them are like, hey, stocks are cheaper now, I'll just keep buying. SPY, though, is interesting. That's the trading crowd. This is $4 billion in SPY. That's a good sign that the traders are not spooked. You'd think they would be. There is a little bit of that, which I'll mention in a minute, but largely the trading crowd's fine. Now, here's where you see a little risk off. Bill and SGov. So you're buying treasuries, you know, just to hide out for a little bit. So a little bit of concern there. Let's look at the outflows. And you're going to see here the top is a BlackRock model rotation, so I won't read too much into this. But this is interesting. TLT, outflows out of TLT and GLD. Again, that would be pretty bullish typically. The Q seeing outflows, I think that's a little bit of the trading crowd taking money off the table, but net, pretty good. I mean, every week we're seeing about $5 billion a day go into ETFs still. Let's look at the U.S. versus the other regions, because I've been hearing all year now that Europe and Asia, everything's doing better than the U.S. The U.S. is lagging. Well, U.S. ETF investors located here, they don't care. So this is money going into U.S. equity ETFs right here. This is this line here. This is international Europe and Asia right here. It's hard to see them. They're barely non-existent. Now, this month is only like a week over, so like you're going to probably end up here. So you can see this year, it's been pretty good. Buying the U.S. stocks has been pretty sturdy, nowhere near the end of last year. But if you look over time, it's pretty consistent. So there is a good amount of buying still. And here, this is Europe International. International, a little bit extra here, I'll give it that. But Europe, I mean, not much. So, Katie, I think it's going to take months of what we're seeing now before you get U.S. investors to bite.
All right, I'm going to pick it up here, Eric. Thank you so much. Joining on our conversation now is Holly Framsted. She is head of global product strategy and development over at Capital Group. Holly, it's great to see you in studio.
Yeah, thank you for having me here. It's great to be here.
So when we look at what's happening in the broad markets and the economy, we went from soft landing and being convinced that's what we're going to get to the increased risk of a recession because of the ongoing trade war. And the trade war also means instability for other markets like Europe, like Canada, Mexico, China, you name them. Are there specific geographies that investors are interested in, whether it's to bet on or bet against as well?
Well, when we think about navigating market volatility like what we're seeing today, it really requires close attention, and it requires taking a long-term view. We believe that investors should recognize that market volatility creates opportunity and that the most important thing is staying invested. Now, I was on the program just a couple of weeks ago talking about CGMM, our Capital Group U.S. small and mid-cap ETF that is focused on U.S. exposure. And we do think now is the time when investors are asking, how do I focus on domestic investments, in particular with the volatility that we're seeing? But I think most important is to take a holistic portfolio view and remain well diversified and invested.
Yeah, and at some point we will see dip buyers emerge, but certainly it seems like there's a lot of scared folks out there right now. But you mentioned CGMM, and I want to build on that because you were telling us in the commercial break that you have plans to put that into model portfolios sometime soon. Now, you do have a model portfolio business already when it comes to mutual funds, but talk to us a little bit about your plans and your ambitions when it comes to building that business for the ETF wrapper as well.
Yeah, so I think two things are true. Capital Group is one of the largest active ETF providers, and that was really our intent when we launched our active ETF business. And one of the biggest questions we've received since launching those funds is when we're going to bring them in models. Because we also manage more than $60 trillion $60 billion. $60 billion in model AUM on behalf of our clients. Now, those are predominantly in mutual funds today. So what our clients are asking us for is to adapt what we're doing on the mutual fund side on the ETF side. And so we're very excited to be very close to launching our all-active ETF models.
Let's go into models a little bit. I think some people might not totally understand the model world. Basically, you have these advisors, right? They manage all this money. They're doing taxes and estate planning. They just want to buy something off the shelf, right, that does all the investing for them. This is what that is, right? So this is like a hitting the easy button for advisors.
Yeah, I mean, I think the concept of a portfolio consultation as an approach to consuming financial advice from investment managers or asset managers like Capital Group can take a few different forms, one of which is consuming off-the-shelf model portfolios. So Capital Group builds the full model and a financial advisor implements that as the investments in their practice. 2/3 of the highest growth financial advisors, according to our recent survey, are leveraging off-the-shelf model portfolios because it's helping them scale their practice. Eric, just as you said, they can spend their time on financial advice with financial planning, tax planning for their clients overall, and they can free up their time by outsourcing the investment management.
You know, it's really interesting to see this, Scarlett. Just a couple of weeks ago, Fidelity out with some news that they're also ramping up their model portfolio business, launching 2 different strategies to put into model portfolios. So it's definitely a trend that's underway.
Absolutely. So how do you separate yourself from the other firms that are launching model portfolios? What can you do that's different, that differentiates yourself? I mean, is it about asset selection? Is it about the products that you offer?
Yeah, so Capital Group manages money for the long term for our clients. Our portfolio managers, and we have multiple on every fund, tend to take a long-term, well-diversified view. Our asset allocation shifts often happen within a portfolio itself. So a portfolio that has flexibility to invest across geographies might favor international markets in a time when our PMs believe that those markets are a better use of clients' assets, and they might favor domestic investments in times where domestic assets are favored. And so when we think about the model construct from a firm like Capital, it's about the careful compilation of a well-diversified pool of funds and fewer overall tactical changes, which from a financial advisor's perspective actually helps them manage taxes because we tend to be trading our portfolios overall less than others might in the marketplace.
So we'll keep an eye out for the launch of that business. Talk to us about, you're starting with CGMM. That is your small and mid-cap approach there. Why is this sort of the debut ETF to go into the model portfolio biz?
Yeah, so actually I would say CGMM is the last bit we needed to launch model portfolios. So with the launch of CGMM earlier this year, we now have 22 ETFs in the US marketplace, which gives us a good variety of equity and fixed income, domestic and international exposures and across the cap spectrum. And so we felt like we finally had the full spectrum of products that we needed to launch a model. And so when we think about this model's entrance, it really is, we finally have the pieces to deliver to our clients what they've been asking us for 3 years.
I'm going to blow you guys away with some data.
Okay, wow, challenge accepted.
25% of all of the flows this year are into active ETFs. 90% of all the launches are active. So it's basically an active takeover. And I wanted to talk to you about how much of this money is sort of just transferring over the mutual fund people into the ETF wrapper, sort of like bringing someone from compact discs into the digital world, versus new money where you have to go and make a sale, hey, buy us instead of Vanguard.
Yeah, so first of all, I love that you always have a music analogy, Eric. I think really the active ETFs are being funded from 2 camps. First, you had the early ETF enthusiasts who really saw the benefits of the structure. It was really only available in passive management. So I believe a large chunk of investors and financial advisors chose the preference of the vehicle over the underlying investments. Now you have active in the ETF wrapper, and that's creating another outlet. So you're always seeing funding from existing sources. I think some of the flows coming into active ETFs are coming from active mutual funds, some coming from Capital Group existing clients who feel this is a better wrapper, and some coming from other existing competitors in the marketplace. But I think we're also seeing The transference of assets to passive management revert, in particular in market environments like the one we're in right now. It's a time where active management can really shine and add value.
Yeah, big time. Holly, it is great to get some time with you, of course, also ahead of that launch of the model ETF biz. So definitely stay in touch. That is Holly Framsted of Capital Group. Now coming up, CEO Jim Bowen made First Trust into an ETF empire, but now its sales practices coming under some questions. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with a new entrant, Bridgewater, one of the world's biggest hedge funds, coming to the ETF wrapper for the first time last week. It launched its famous all-weather strategy in ETF form. This is a risk parity strategy. Tends to do well in times of market volatility. That's exactly what we're seeing right now. So a very well-timed ETF launch from State Street and from Bridgewater. Speaking of volatility in markets, let's take a look at the Qs and specifically what we're seeing in the option space. I thought this chart was really interesting. You take a look at the number of options on the Qs. It's at record levels just about. So traders really using the Qs to either hedge their bets or place directional bets on where the heck we go next. I did want to end with a really interesting piece of enterprise reporting coming out from our Bloomberg News team, all about First Trust. It's it's a pretty big issuer, about $250 billion in assets under management, not quite Vanguard or BlackRock levels, but it has been known in the industry for some pretty aggressive sales tactics. And according to our reporting, that's come under FINRA's investigation as well.
Yeah, regulators taking a closer look at what's happening over at First Trust. So let's talk more about this story with Bloomberg's Max Abelson, who co-wrote the story with Emily Grafeo. Max, Katie kind of alluded to how it was an open secret that First Trust had an aggressive sales approach to selling its funds. What was the secret sauce?
Well, look, I mean, there's definitely a positive way of describing it. ETFs are dominated by these huge companies. You mentioned one of them. And, you know, if you're a small rival, what is there to do? One thing to do is to be really well known for entertaining. And what we're talking about here is essentially a kind of middleman that, you know, if you have an ETF, maybe you just buy it yourself. That is not what we're talking about here. We're talking about First Trust, salespeople who are known as wholesalers, entertaining financial advisors who then essentially sell the ETFs to customers like, you know, my mom. And, you know, I want to make clear that the rules from the essentially self-regulatory arm of Wall Street called FINRA, some of them are a little bit foggy. And what our reporting is about, and I hope people read our Business Week story, is about basically a batch of internal emails that we have and a lot of interviewing that we did, especially Emily, shows that First Trust was essentially sort of like basically going up, right up to that line, or maybe potentially crossing it.
Yeah, I want to read one of those emails. This is about 6 years ago. A managing director chided colleagues, writing that, quote, pay to play is obviously illegal, but we have wholesalers doing it repeatedly. So that looks pretty bad. Talk us through a little bit more of the reporting that went into this, because reading it, it really comes through.
Well, first of all, thank you so much for saying that. I'll tell Emily you said so. Okay, but
She's probably watching right now.
I want to bring up that email. Obviously illegal, but we have people, you know, doing it repeatedly. Matt Levine, your friend and money stuff writer, you know, he points out something quite fair, which is like maybe actually a well-run company would have an email like that. You are doing something wrong. We want you to do it right. Obviously, when you read it in black and white, when we reviewed the email, you know, does it look great? Do most companies want things like that put in writing? I am assuming that they don't. But at least, just to be fair to First Trust, at least this is someone saying, stop doing that. You know, there's a theoretical world where instead the emails we have are like, you're breaking the rules and we want you to keep breaking them. And that is not what happened here. But I will tell you about reporting. You know, it was fun for me to, you know, write about a field that is not it's not my cup of tea necessarily. Emily Grafeo knows a lot more about ETFs than I do, and so does Eric, who's on set. It was fun for me to sort of be introduced to a company that, for me, flies under the radar. and has clearly done something right. Financial advisors in parts of this country that are seen by coastal elites as like flyover country, clearly financial advisors really admire First Trust, and First Trust clearly admires them. And it was fun to sort of get to know a company and try to understand its secret sauce. And yes, maybe there are parts of that secret sauce that FINRA won't be happy about. But to be fair, the investigation is ongoing. We do not know how it's going to end.
Right. Yeah.
So we'll be stay tuned. We'll be stay tuned to see what happens.
It's a good point about the flyover. I think they are really get the middle of the country for sure. And the other thing is their ETFs are not beta, right? They have IP in them. They're like smart beta. And so for a fiduciary advisor, it's not like they're buying First Trust at 60 basis points when you get Vanguard for 3. This is a different type of ETF that's trying to beat the market. So that also makes it hazier.
Yes, I sort of fell in love with this concept of that ETFs have this kind of democratic glow, and that in a way, I think Jack Bogle's brilliance was this idea of inventing something that's just like about being average. So much of Wall Street, the Wall Street that I cover, is dog eat dog and eat what you kill and being smarter and being more aggressive. And it was interesting for me to learn about ETFs as sort of coming from this like brilliant seed of averageness, just trying to capture the overall market's returns. But First Trust, to be fair, is doing something a little bit different than that.
All right. Well, they are charging more than the big guys, and so that's also what gets people's attention as well. Max Abelson of Bloomberg News, fantastic story. An all-American ETF empire draws billions and a regulator's eyes. You can check it out on the Bloomberg terminal and at Bloomberg.com. All right, let's just give you a recap here of what's going on in equity markets. The S&P 500 losing more than 2% right now in midday trading. The Nasdaq down even more, off by 3.5%. And of course, investors are flocking to the safe haven of treasuries. You can see there the 10-year yield down 8 basis points. This is Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, today we're looking at the Rockefeller California Municipal Bond ETF. It holds California munis. Everybody like tax-free income. People like that. So the yield, basically you double it around there for tax equivalent. And RMCA is the ticker. It tries to beat the benchmark. So it charges a little more, 55 bips. It's about 6 months old, 17 million. Let's look at the holdings. That's the important thing here. And you're going to see airports are the biggest type of muni in the fund. And then you're also going to see schools. I like munis because you can really visualize these things, water, schools, tolls. So it basically trying to pick these munis to beat the benchmark. Now, is it doing that? Let's look at what I would think the benchmark is CMF. That's the iShares Muni ETF that tracks an index for 8 basis points. So that's like beta. And so it is. It's beating the market or this ETF by a little bit here. And they're both beating, or it's beating the ag as well. So that's going to help, Katie, for a new ETF that's active. Getting that early outperformance is going to help it get some looks.
All right, Eric, thank you. And joining us to talk about this ETF, I'm thrilled to say we have Alex Petrone. She is Director of Fixed Income over at Rockefeller Asset Management. Great to see you in person.
Great, wonderful to see you. Thanks, Katie.
So this is something we've talked about before, but I just love the idea of single state ETFs. We have single stock ETFs, we have single state ETFs. When it comes to muni bonds, what is the pitch to investors why they should invest solely in a specific state?
Sure, it really boils down to taxes, right? Why are we in the municipal market? It's to save on federal as well as state taxes. So not all states are states that you should own state-specific funds, but California and New York, particularly for New York City residents, are two of the states where the tax rates are quite high. So for investors, when we look at it, it's really a relative value play, national market versus in-state market, and can I do best in-state versus national? Now, I will say part of why it's doable in both California and New York is because you have large states with lots of issuance where you can diversify quite nicely across sectors, as Eric mentioned, as well as algo growth. So I would view it a little bit different than that single stock equity because it's a well-diversified basket.
So you're not going to do like triple leverage California?
We are probably not going to do triple leverage California at the state level on its own. What we're looking towards, and this can shift at different points in time, what we love about the municipal market, why we lean into active, it's a highly inefficient market.
Yeah. That wasn't a real question, but I'm so tickled that you took it seriously. What I really wanted to ask was, reading between the lines of what you're saying, it sounds like, you know, if you picked out California and New York, because they have high taxes, that a state like Florida wouldn't make sense to put in this wrapper.
Not for the bulk of your allocation. You want to reserve some dry powder for national names at different points in time, particularly as you venture into the yieldier areas of the market, or if there's a dislocation that impacts a sector or a state. So we reserve the right to buy some national, and often across some of our California strategies, you'll see that. But it's going to be in those areas of the market where we say, on an after-state tax basis, this is interesting for our investors.
How do you think about the Trump administration reducing government spending and reducing government funding, especially for states that are blue states, like a California, like a New York? What does that mean for the universe of bonds that you can look into buying?
I think we always should have been mindful of the idea that, as we saw rising deficits, or whatever the factor is that drives this, that there would be some diminished federal funding transfers to the states. Whether that's thinking through FEMA through time, whether it's thinking through other areas that I know are in focus right now, fiscal policy can impact the states. Federal funding transfers, whether it's at the school level, whether it's impacting healthcare, hospitals, and the likes, is something you have to be mindful of. The most important thing we do as active investors, rigorous bottom-up fundamental analysis, and ensuring that as we're allocating across the expanse of the municipal market, that no one factor could materially change the balance sheet in the near term.
I have a question for you. This is a little random. Why hasn't anybody launched muni ETFs that are based on the sector? Because it's so tangible, like airports, schools, hospitals. I feel like people may respond to that. Do you find your clients care where the money's going because it goes to these physical places, or it's just the tax issue?
I think investors want us to make that relative value decision among sectors as things change through time. So while that maybe is the breaking next idea that we have for a sector-specific municipal ETF, heard here.
Who accepts a commission for that?
Done.
Schools and hospitals.
We'll talk about it offline.
It's like real ESG.
But I think it really boils down to the investor, when they're looking for an active manager in munis, they're saying, you're the experts. You've been doing this for decades. Tell us at different points in time which sector is most attractive and why, or when we want to lean out of things, because that changes through time depending on some of the macro factors, the federal funding factors, or what's going on within a state.
Alex, so enjoyed this conversation. Have to have you back soon. That is Alex Petrone of Rockefeller Asset Management. And you can read about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. Let's get a quick check on these markets, though, because the sell-off deepening as we're speaking. The S&P 500 down about 2.3%. As you can see, that pain really emanating from big tech. The NASDAQ 100 up by about 3.3%. Eric was making the point earlier that you take a look at SPY volumes. They're not crazy right now. It's been an orderly sell-off, Scarlett.
It's been orderly, and that's what we'll be monitoring throughout the day. And, you know, there's been a bout of weakness here as President Trump makes clear that a recession could be in the cards, or at least not taking it off the table.
A transition period for the economy. The markets,
a rocky one.
Markets don't seem to like it, but that does it for this week of Bloomberg ETF IQ. I'm Katie, along with Scarlett and Eric, and this is Bloomberg.